Most people think hitting $100,000 in savings is the finish line. It's not. It's actually where the real game begins. And if you don't know what to do next, that $100,000 will sit there, losing value, while the cost of everything around you keeps climbing. Today, I'm going to walk you through exactly what to do once you've saved $100,000 in America, so your money actually starts working as hard as you did to earn it. Let's get something straight first. If you've saved $100,000, you've already done what most never do. According to Federal Reserve data, the median American has just $8,000 in transaction accounts. While the average sits at around $62,000, you're way ahead. But here's the trap. A lot of people hit this number and then freeze. They don't know whether to invest, pay off debt, buy property, or leave it in savings. And that indecision is costing you real money every single day. So the worst thing you can do right now is nothing. And the second worst thing is making an emotional, uninformed decision. What you need is a clear plan, and that's exactly what we're building today. Step one, emergency fund. Boring, but critical. Before you do anything else, you need a proper emergency fund locked in. The standard rule is 3 to 6 months of essential expenses. Given the current environment, inflation's still hovering around 2.7%, and unemployment ticking up to 4.6%, the highest level in 4 years. I'd lean towards 6 months if you can swing it. Based on recent data showing the average household spends about $6,080 per month. Most Americans should target between $18,000 and $36,000 for their emergency fund. Park that money in a high-yield savings account. Even though the Fed has cut rates several times in late 2025, many high-yield savings accounts are still paying close to or above 4.00% APY. As of May 2026, CIT Bank is offering around 4.1% APY, while the national average savings rate is a pathetic 0.38%. This is not your investment money. This is your sleep-at-night money. It's the buffer that stops you from panic selling your investments or running up credit card debt the moment something unexpected hits. Life doesn't send warnings before it sends bills. Step 2. Destroy high-interest debt. Once your emergency fund is locked away, here's where it gets interesting. If you're carrying high-interest debt, credit cards, or personal loans, you need to attack that next. It doesn't matter how tempting it is to invest. No S&P 500 ETF is consistently returning 20% to 25% per year, which is exactly what the average American credit card is charging you in interest. Paying off a $10,000 credit card balance at 22% interest is like earning a 22% return. And here's what most people don't think about. Once that debt is gone, the monthly payments that were flowing to the bank are now free cash flow. That money can be redirected straight into investments. And psychologically, something shifts when you become completely debt-free. The mental weight disappears. Every dollar you earn is yours to keep, to grow. Step 3. What about student loans? This is where a lot of people get confused. After all the recent shakeups to the federal student loan system, income-driven repayment plans have been significantly disrupted. Current interest rates on new federal student loans range from 6% to 9%. If your student loan interest rate is below 5%, make minimum payments and invest. But if it's 7% or higher, paying them down aggressively makes mathematical sense, especially Parent Plus or Grad Plus loans. You can't reliably count on the stock market to beat that rate after taxes. And don't forget, if you work in the public sector, check public service loan forgiveness. Throwing money at loans that would have been forgiven is one of the most expensive mistakes. Step 4. Invest in index fund ETFs. Now let's talk about the big one, investing, and specifically index fund ETFs. An ETF lets you buy a slice of hundreds or thousands of companies in one purchase. For Americans, the most popular options include VTI, Vanguard Total Stock Market. VOO or SPY tracks the S&P 500. VXUS gives you exposure to developed and emerging international markets. VT, an all-in-one global world ETF. The beauty of ETFs is simplicity. You don't need to pick individual stocks. You just own a broad slice of the economy and let compounding do its thing. So should you dump all $100,000 into ETFs at once? Not necessarily. A strategy called dollar cost averaging lets you invest a fixed amount at regular intervals, say $5,000 or $10,000 per month, instead of going all in at once. This smooths out the bumps. You buy more shares when prices are low, fewer when they're high, and over time your average cost per share evens out. It takes the emotion and the guessing out of the equation. Vanguard and Fidelity research shows this approach helps investors stay disciplined. And discipline is the single biggest predictor of long-term investment success. Step 5. Retirement accounts, where most people leave free money on the table. Here's the move most people don't fully take advantage of: 401k and IRA account. They're not exciting. You can't touch the money without penalty until 59 and a half. But the tax advantages are enormous. For 2026, the 401k employee contribution limit is $24,500, with a combined employee and employer limit of $72,000. If you're 50 or older, you can contribute an additional $8,000 catch-up. Those aged 60 to 63 can contribute up to $11,250 extra. If you contribute to a traditional 401k, those contributions are pre-tax, meaning you immediately lower your taxable income for the year. At a marginal tax rate of 22%, 24%, or 32%, that's an instant return. And don't forget the Roth IRA. For 2026, the contribution limit is $7,500, or $8,600 if you're 50 or older. Single filers need MAGI below $153,000 to make a full contribution, and married couples filing jointly need MAGI below $242,000. Money inside a Roth IRA grows tax-free, and you withdraw it tax-free in retirement. It's one of the most powerful accounts in the entire U.S. tax system. And here's the most important thing: if your employer offers a 401k match, say they match 50% on the first 6% of your salary, contribute enough to capture the full match. Anything less means turning down free salary. That's an instant, risk-free 50% return. Step 6. Real estate, is it worth it? With $100,000, you technically have a 20% down payment on a $500,000 home, which avoids private mortgage insurance (PMI). But in major U.S. cities like San Francisco, New York, $500,000 doesn't get you far. The good news is that if you're a first-time homebuyer, there are plenty of programs. FHA loans require just 3.5% down, VA loans for veterans can require no down payment, and conventional loans with as little as 5% down are still doable. But real estate comes with closing costs, property taxes, and maintenance. Homeowners insurance, HOA fees, and the risk of being locked into a mortgage. While the Fed funds rate sits at 3.50% to 3.75%, and 30-year mortgage rates are still hovering around 6% to 7%. Run the numbers honestly. Sometimes renting and investing, the difference is better, especially if you're not sure you'll be in that city for at least 5 years. Putting it all together, a concrete game plan. If you've got $100,000 sitting in an account right now, here's how to deploy it. First, carve out $20,000 to $30,000 as an emergency fund in a high-yield savings account. Next, wipe out every dollar of high-interest debt above 7%. Then contribute enough to your 401k to capture the full employer match. This is free money. Don't leave it on the table. After that, max out your Roth IRA for the current year, $7,500 if you're eligible. And consider increasing your 401k contributions toward the $24,500 cap. Finally, dollar cost average into a simple 2 to 3 fund ETF portfolio. Something like 60% VTI, 30% VXUS, and 10% BND bonds. Set it up, automate it, and leave it alone for 10 to 20 years. Why most Americans never build real wealth. It's not because they don't earn enough. It's because they never make their money do the heavy lifting. $100,000 sitting in a checking account earning 0.01% is losing purchasing power every single day as inflation eats away at it. But $100,000 deployed properly can become the foundation that changes your future. The difference between someone who retires comfortably and someone stressed at 65 usually isn't income. It's what they did at moments exactly like this one, when they had a lump sum and the chance to set things up properly. If you got something out of this video, subscribe and turn on notifications. Thanks for watching, and I'll see you in the next one.